Assalamualaikum everyone. Welcome to Meezan Bank's analyst briefing session. My name is Suhail Khan. I'm the company secretary at Meezan Bank. Uh, I'll just start the session today, and the first thing we'll do is I'll introduce you to the team that is with us today. We have with us Mr. Irfan Siddiqui, founding president and CEO of Meezan Bank. We have Mr. Syed Amir Ali, the deputy CEO of Meezan Bank and the president designate, and CFO Syed Imran Ali Shah. And the sequence for today's event would be as follows. We have opening remarks from the CEO, and then our CFO will then do a presentation on the financial statements. After the presentation, the forum would be open for questions and answers. And my only request to the participants would be that for the question and answer, please use the raise hand option given in Zoom. We'll take the questions one by one and admit the questions in sequence. And while asking the question, we would request you to kindly first introduce yourself and the organization you are representing. And one more request is to kindly refrain from making comments and kindly please do restrict yourselves to specific questions. I would now like to invite Mr. Irfan, Mr. Irfan Saab for his comments, sir.
Right, Assalamu alaikum and Bismillah ar-Rahman ar-Rahim. Welcome to this briefing session. I only have one major slide. Alhamdulillah, our profitability was much stronger than what we expected, considering that this is the first quarter where we had the hit of MDR. Then last year, you were aware, tax rates was increased by 5%. And then obviously decline in the policy rate. So our net profit after tax closed at 22.1 billion compared to 24 billion in the previous quarter. So there was a small drop. But considering that these three things happened, we are quite happy that mashallah it came in at this level. Our total assets crossed 4 trillion, just marginally over 4 trillion. And based on the our earning per share was 12.28 rupees per share. The other thing which we are quite happy is that our deposit in one quarter alone went up by 11% to 2.88 trillion. And most of the addition was in CASA. In fact, all the addition probably was in CASA. Imran would give you an exact slide on that. And our ADR, which had gone at a much higher level because of the ADR tax, is now rationalized currently at 50%. At December, it had gone up to 60%. And return on equity, because the higher base effect of equity was locked in at 36%. As a result of all this, Alhamdulillah, Meezan continues to be in the forefront of all the awards and recognition. I think that's the next slide. So most of the awards in Islamic banking was obviously, mashallah, won by Meezan. But in addition, a lot of awards which were conventional and Islamic put together was also taken by Meezan banks. I think of particular interest was the Pakistan Banking Award, which used to be run by what was called the IBP, Institute of Bankers of Pakistan, is now been taken over or merged with NIBAF. So the new institution is National Institute of Business and Finance, which is a subsidiary of State Bank of Pakistan. So we're very happy that, under the Governor State Bank's patronage, this award, which is effectively given by a subsidiary of State Bank of Pakistan. So Meezan was classified as the best bank for 24, best bank all around, including Islamic, conventional, everything put together. And it was not just in 2024, we got the same award last year as well. So it was 2 consecutive years. And previously we got the same award in 2020 and 2018. So we are the only bank to get this award 4 times in 7 years, compared to any other bank which is maximum got for 2 years. So I think that is reflective of how the industry rates us as well. In addition to the banking the CFA award, an Asian PVA award. The other major award is the CFA Society of Pakistan. Again, Alhamdulillah, they've been giving us the award for the last consecutive 5 years as the best bank in the large size category. So this is the fifth year we've got this award. And in addition, obviously, we do maintain the Best Islamic Bank of the Year, Best Digital Banking Services Award was also given, and Best Transaction of the Year. So Alhamdulillah, it's a good story to tell, and I hope that we would continue in this journey, and hopefully Amir, who's here with us now, would be taking over end of December, and then inshallah, I hope he can take it Meezan to greater heights, inshallah. So thank you so much, and I'll hand it over to Sohail again. Yeah.
Thank you, Irfan sir. Imran Nisha sir, could you kindly continue with the performance overview, sir? Thank you so much.
Thank you, Sohail Saab, for the introduction. Assalamu alaikum and a warm welcome everyone to the analyst briefing session. As Mr. Irfan Siddiqui mentioned, our profit after tax is down compared to the corresponding period last year by 2.8 billion or roughly 12%, which in totality is an excellent performance by the franchise, especially on the back of the policy rate going down by 10 percentage points from 22 to 12%, the imposition of the MDR on Islamic banking industry, as well as the tax rates now being applicable at 53% instead of 49% in Q1 last year. Cost to income ratio has come down slightly from 28.8 to 28.1%, whereas return on equity has decreased from 52.9 to 36.2%, primarily on the back of the equity base increasing year over year. Capital adequacy ratio also registered an improvement from 20.35 to 23.21%, whereas deposits went up by 11%, of which current accounts grew by around 14% and saving deposits grew by 9% just during the quarter. In terms of the CASA mix, our mix has remained in line with December numbers. So most of the growth has actually been registered in the current account segment, whereas the branches year over year have gone up from 1,007 branches to 1,052 branches. If you look at the gross financing number, we have seen a slight decline in the gross financing number from 1.56 trillion to 1.44 trillion. This is primarily being driven by the seasonal financings which we do during Q4 coming off in Q1. Consequently, gross ADR has reduced from 60.2 to 50.1%. We also saw NPLs go up by around 5.1 billion. The main driver here is some subjective and prudent provisioning we have done relating to the textile sector. NPL ratio consequently went up just above 2%, whereas NPL coverage ratio is still at a very healthy 143%. We also saw an increase in our investments portfolio of around 180 billion, with the total portfolio now standing at 2.05 trillion. If you look at the year-over-year comparison of the quarterly profit, the main driver here is obviously the decline in the net spread earned, which went down by 8%. Here, the main effect was primarily the sharp decline in the policy rate, which was offset by the volumetric growth in our deposit and investments portfolio. Fee commission and other income is also up by 10% year over year, which is primarily being driven by trade income being up 21% and branch banking income being up by 16%. On the foreign exchange income front, we have seen a healthy increase in profitability and margins, with the FX income going up from around 478 million to roughly 1.6 billion for the quarter. Dividend income also registered a healthy increase of 60%, mainly on the back of dividends from our subsidiary Al Meezan Investments. In terms of operating expenses, the expenses are broadly in line with Q1 2024. The main driver of the slight decline here is the lower variable compensation expense, which is driven by obviously bottom line profitability, as well as reversal of some excess bonus provision from previous year. Before provisions were down 4%, whereas profit after tax was down 12%, with basic EPS coming in at 12.28%. Compared to Q4 2024, i.e., the quarter-over-quarter movement, our profit after tax is down 8%, with net spread earned being down 15%. This is again primarily because of the decline in the policy rate averages, whereas total income is down 16%. Operating expenses and other charges are up by 9%, whereas profit before provisions are down 22%. So all in all, profit after tax was down from around 24 billion to roughly 22.1 billion, or 8%, from the December quarter. I just want to highlight that our profit trajectory has been very strong, and the last 3 years CAGR growth in profit after tax has been 37%, despite the tax rate increasing from 39 to 49%, and then reaching a high watermark of 54% last year, whereas the tax rates are now standing at 53% for this year and would reduce to 52% next year. Obviously, due to the declining average policy rate, we expect our profit after tax to drop. However, we are taking various measures to mitigate that impact, and inshallah would look to close that gap as much as possible through volumetric increase and growth in our NFI. In terms of the balance sheet, total assets went up 32% year over year and were up 3% compared to December. Islamic financing and related gross assets increased by 55% compared to March 2024, but are down due to seasonal fluctuations by 7% compared to December. Total investments are also up 26% compared to March 2024 and roughly 10% compared to December close, whereas deposits are up 27% versus March and 11% versus December close. The main driver of the increase in our deposits portfolio has been current and saving accounts, with current accounts, as I've mentioned earlier, growing by 14% in the last quarter alone. In terms of the key ratios, our ROE reached a high watermark of 56.3% at the end of 2023. This has now rationalized somewhat to 36.2%, but the main reason for that decline in ROE is the improving equity base, which we hope to leverage in order to continue our balance sheet growth and growth in our financing portfolio, inshallah. ROA is at 2.3%, whereas cost to income ratio has been stable just under 30% for the last 3 years now. Our gross ADR percentage has also been hovering around the 50% mark for the last 3 years. If you look at the deposit growth compared to March 2024, our total deposits were up 27%, or roughly 610 billion, of which current accounts contributed 323 billion, or roughly 30% growth, whereas saving deposits also grew by around 35%, or roughly 330 billion. Our market share at the end of December was around 8.5%. At the end of March, our market share has now crossed 9%, whereas CAGR growth in our deposit base since inception has been at an impressive 33%. I would also like to highlight that Meezan bank's deposit composition is highly granular, with retail and individual depositors contributing roughly 71% of our total deposits portfolio, with the private sector contributing another 25%. In terms of the branch network, we are now operating with more than 1,000 branches across 351 cities. We are focusing on expanding both our digital offering as well as our physical footprint, and would inshallah be looking to continue to open new branches in areas where we foresee high deposit growth going forward as well. In terms of the investments portfolio, our total investments portfolio stands at 2.05 trillion, of which GOP Jara Sukuk contribute around 1.9 trillion. And out of this, around 20% is in fixed rate Sukuks, and around 80% or roughly 1.5 trillion is in variable rate Sukuk. In terms of the financing portfolio, if you look at our trend analysis, our financing portfolio has more than doubled over the last 3 years, going from around 700 billion to close to 1.5 trillion, whereas our coverage has also consistently been very high and currently stands at 143%. In terms of the composition, roughly 81% of the financing portfolio is with top-rated corporate clients, around 13% is with mid-market commercial and SME clients, and roughly 5% of the portfolio is with consumer clients. Our total provision is around 43 billion, of which 13.6 billion is general provision over and above the IFRS 9 stage 1 and 2 requirements. We also have a very healthy CAR at 23.2%, which is around 11.7% in excess of the minimum regulatory requirements. But we also want to highlight that given our focus on volumetric growth, this CAR is needed to support our future expansion plans. In terms of the fee, commission, and other income, we saw a healthy growth of 10% year over year. Debit card related fees were down 4%. The main reason of this drop were some one-off portfolio cleansing activity, as well as the fact that although we are very aggressively rolling out our debit card to our new to bank customers, we are looking to offer part of this portfolio with the first year being free of cost, which obviously means there is a slight drag in the year one of issuance. But over the long term, this should inshallah lead to a healthy growth in our debit card related fees income. Trade related fees and commissions were up 21%, whereas branch banking fees was up 16%. Cash management was also up 25%. Whereas home remittance related fees have gone up significantly from around 46 million to 234 million year over year. Similar trend is seen in our trade business volumes, which are up by 16% versus last year. And the mix of the imports versus exports has also changed, where now imports are contributing around 59% and exports are contributing around 41% of our trade volumes. It's also pertinent to highlight the performance of our subsidiary Meezan Investment Management, which is the largest asset management company in Pakistan, with an investor base of over 400,000 customers. Their AUMs year over year were up by 33% to close at 636 billion as at 31st of March, with a profit after tax of 890 million for the quarter and a return on equity of 65.8%. Finally, in terms of our digital channel stats, our total cards portfolio stood at 3.9 million total debit cards in issuance. This is slightly down from December. The main reason here is that although we have issued more than 300,000 new cards, We have also taken a cleansing activity to close dormant, see a significant uptick once that one-off activity has been completed. And inshallah, our debit card portfolio is expected to grow by at least 20% over the upcoming 3 quarters. POS machine deployment is also up, whereas mobile app active users have also gone up from 2.4 million customers to 2.55 million customers. That's the end of my presentation. Thank you for listening intently. We'll now be open to questions.
So first question, we have a raised hand, Mr. Raza Inam, MCB Funds. Raza, please go ahead. वो सवाल आया नहीं उनका. So what I'll do is, there are no raised hands. There is one, sir. Yeah. Okay. Just a moment. Shehbaz Ashraf. You can unmute yourself, sir, please. Shehbaz sir, you can unmute yourself, sir, please. Go ahead. Okay, so I think we'll come back to Mr. Sergey. Mr. Sergey, please unmute yourself and.
Hi.
Hi.
Yeah, so the participants aren't able to unmute themselves. It has to come from your end. So that's why the initial trouble. Congratulations to the numbers. I think you've done quite well considering the falling interest rate environment. So my question is, what are the prospects for the coming quarters? Have we seen the worst already from the declining interest rate impact, or will we see more impact or stronger impact in the coming quarters?
Imran, if I may answer that. Good question. In Pakistan, we feel that we've taken most of the beating. So if the interest rate goes down further, maybe there's a 0.5%, 1% in it. But I mean, if we've seen a 10% variation and we have survived that, so hopefully another 0.5% also will survive. So I think that's the mindset that, we have to make compensating efforts on the other side to make things happen.
So from the 10% decline, you have seen already the worst. Impact that has fully impacted your performance already.
Yeah, it's more or less fully impacted because we have some fixed term sukuks available, which the differential is also not too great compared to the current rates. So maybe some repricing would happen there as well. But like you said, I mean, we've seen the worst is over. So there's smaller deviation.
And just to follow up on that, so is it fair to conclude that then from maybe not from the second quarter onwards, but from third quarter onwards, certainly we should see quarter-over-quarter earnings growth again?
I think it all depends on the growth in our business as well. Obviously fueled by deposit and then on the asset side. So inshallah, obviously our effort would be there to increase the business in a way to compensate that. But obviously that's something which we obviously are hoping, but we have to wait and see.
Thank you very
Just
much.
to add in the same point, So if we just fragment your question into two, one is the possibility of decline in policy rate, on which Irfan Saab has guided you. The other one is the resetting of our earning asset book. So there is always a lag when there is an interest rate cut, and by the time it is actually translated into the earning yield of the asset. So some of the assets are repriced within a month's time, some are repriced within 6 months' time. On average, we have seen it takes 3 to 4 months for all our assets to reprice. So as far as the old rate cuts, almost all assets are repriced, but as far as very recent rate cuts are concerned, in the second quarter, we will also experience some repricing. But on the other side, there is a significant increase in average earning assets due to increase in deposits. So it will be that impact will be compensated by volumetric growth. So we expect growing profitability going forward.
Very helpful. Thank you very much.
Thank you, Mr. Shakir. We have Mr. Raza Anam of MCB Funds. Raza Saab, kindly unmute yourself, sir.
Okay, Assalamu alaikum, sir. Am I audible?
Yes, sir, you are audible.
Okay, sir. I'm Raza Anam from MCB Funds. Sir, I have two questions. My first question that as per the SBP circular, the Islamic Bank have to pay around 75% of the weighted average gross yield to saving depositors. However, as per our calculation, the number is below 60. So can you please explain this? And my second question is that have the total impact of MDR visible this quarter, or it will be visible in the upcoming quarters?
So Imran, I think you can answer.
So thank you, Raza, for the question. In terms of the first part of your question, yes, the SBP has now mandated the Islamic banks to pay out 75% of the gross yields across all pools to the vanilla saving depositors, subject to some direct and specific expenses and assets being taken into account. So again, it is very difficult for there to be a uniform number in terms of how that is being calculated, because different banks could have different total assets, different yields and portfolios. The impact of MDR has fully been baked into our Q1 numbers. So because the MDR was applicable from the 1st of January onwards, our Q1 results are reflective of that. The effective profit distribution, in our case, it could be different for different banks, is significantly higher than the 60% you have quoted, but is again, because of the inclusion of direct expenses, it is below 70%.
So just to add into Imran's explanation, if you look at the circular issued by central bank, so there are two things which were excluded or were allowed at a reduction, one can say. One is certain types of depositors, like public sector large entities, like certain listed corporates. So there was classification of depositors which were not eligible to get that deposit. So that was one difference. And the other one was there were certain direct expenses which were directly attributable to the pool of earnings, which is distributable to the depositors. So after these two adjustments, we are following the exact same formula, that whatever is our earning yield on our actual assets, or actual earning yield on our assets, subject to these adjustments, 75% of that is actually transferred to the depositors pool and is distributed among them. So, and as far as Imran has rightly mentioned, as far as the impact is concerned, because this circular is applicable since the beginning of the quarter, so it is applicable on January, February, March, all 3 months. So the entire impact has kicked in. Now, any future impact will be dependent upon the change in the overall earning yield at the top line. So if top line grows, the sharing will grow. If top line goes down due to reduction in interest rates or policy rates, the sharing will go down. So now there is no change in the formula or calculation methodology going forward. So the impact is fully built in.
Thank you very much, sir. We have Mr. Farhanul Haq. Farhan Saab, kindly unmute yourself.
Thank you very much. I have two questions.
Farhan
One of
Saab,
it
could you
is
kindly
that
introduce yourself, sir? Would you kindly
Yeah,
introduce
yeah.
yourself, sir?
I'm head of equities at Al Habib Asset Management. So my
Thank you.
question is that last year your admin expense were quite high, and that was due to around 19 or 20 billion bonuses given to the employees, and that being so because your results were quite phenomenal. Given that going forward this year your results would be lower due to lower interest rates, so what's the guidance on the admin expense side, uh, given that your bonuses, what would be your bonuses going forward, and what would be the admin expense going forward? Would we see a year-on-year decline in admin expense? And secondly, we've seen that the OMO injections at the Islamic side, they were around 1 trillion uh, last year, but they went down in the last quarter, and they've shot up again in the first quarter. So, where do you see Islamic OMO going forward? Would they hover around these levels, or are they expected to go down?
So, thank you, Faransa, for the questions. I think the answer to both of your questions, it would really depend. So in terms of your first question around the variable compensation or the bonus, it is a function of many factors, among which obviously the profitability is one of the significant drivers. Uh, we don't know where the policy, the overall profitability would end up at the end of the year. Obviously, that would drive the variable compensation expense. In terms of the non-variable compensation expense, uh, I think a fair assumption would be that they would grow in line with the overall inflation prevailing in the country. So you could expect a growth of between 7 to 10% depending on the overall inflation prevalent in the country. Your other question was around OMO. So you are right that the open market operations or the borrowings from state banks have gone up recently. Again, in the case of Meezan Bank, that is predicated by the investment opportunities, whether in the Sukuk auctions or whether in financing opportunities that we might have. They dictate what OMO strategy we follow. So if we get opportunities for investment, then obviously on the deposit side, the growth is generally organic and in a linear basis. So OMO is one of the avenues where we might be able to raise excess liquidity to then deploy either in our investment book or in expanding our financing portfolio. So both would really depend on the opportunities that we get throughout the year. And I think that is also going to be true for the rest of the Islamic banking industry, because remember that generally the reinvestment rate on a standalone basis for Islamic banks carry a negative carry compared to the borrowing rates from the state bank, which is not the case for the conventional banks.
Thank you, Vinasa. We have Mr. Farhanul Haq and Mr. Razai Namam again. I'll ask Farhan Saab to unmute yourself, please, sir.
Just wanted to confirm that for this OMO that you are financing your book with, do you create a different pool for this borrowing for taking this OMO, or is it the same pool that you are giving to the depositors?
So we have a different pool for treasury instruments. But remember, the state bank circular that predicates the minimum deposit rate talks about the weighted average yield across all pools, not just the general pool.
Thank you,
So
Vinasa.
we have a
Mr.
different,
Razai.
we have to take the weighted average yield across all pools, not just the general pool.
Thank you, Vinasa. Mr. Zainam, you could kindly unmute yourself, sir.
Okay, sir. I have a follow-up question to the explanation regarding the MDR. So, sir, what sort of direct expenses are we can deduct from the pool while calculating the saving deposits? And if this is the case, can we expect the similar NIM to continue in the future?
So, Raza Saab, if you look at the circular and the FAQs accompanying the circular, they have very detailed instructions on which expense we are able to deduct. Um, and I think you can just get all the details from the circular itself, because it is a very detailed document and FAQ which has been released by the State Bank. I can go into the details, but I think it would be doing a disservice to the remaining attendees if you
Thank
go
you very
into.
much, Imran sir. We have no room more raised hands, but we have a few questions on chat. One question from Mr. Sunny Kumar of Topline Securities is: the bank recorded 11% quarter-on-quarter growth in deposits. Could you please share the reasons for the significant quarter-on-quarter growth and the outlook for the next 3 years?
Ji, thank you, Sunny. I mean, as you are aware, up until the very end of 2024, ADR related taxation, i.e., asset to deposit ratio related taxation, was applicable on the banking industry, which was withdrawn towards the end of December 2024, which meant that most of the banking industry had muted deposit growth in Q4 last year. Now that ADR is not applicable, most banks are looking to grow their deposit book, which is what is providing the impetus for us to also record significant growth over the last 3 months of 2025. In terms of the outlook for 3 quarters, we'll obviously be looking to register growth in line with our previous performance, and I think it would be prudent for you to assume a growth of around 20 to 25% in the deposit book over the 12-month period.
Thank you, Imran sir. We have a question from Sayyid Murtaza Hassan. Can you please provide guidance on the decline in fee and commission?
Sorry, I think Sohail Saab, if I read the questions here, it's saying, can you provide guidance on the average yield on FRR portfolio and then the ADR target for.
Oh, yes. Oh, I missed that. You're right.
20.
Sorry.
So, Murtaza, the average yield on the fixed rate portfolio is around 12.3%. And the ADR target for calendar year 2025, although we don't have a specific target in mind, because it really depends on the opportunities we have to extend financing to top-rated customers, we would still ideally like to target an ADR around the 50% mark.
Thank you, Imran sir. And the next question is: could you please provide the breakup between average yield of fixed and floating Jara Sukuk? And what is the average duration of fixed Sukuk? And when will the floating rate portfolio be repriced?
So, Waleed, in terms of the fixed rate Jara Sukuk yield, I've already provided you the details. On the variable rate Sukuk, the average yield is around 13%. And we expect that once our variable rate Sukuk portfolio has completely repriced, there would be an impact of around 30 to 40 basis points on the investment portfolio, which is obviously going to happen in Q2. In terms of your other question around the average duration of the fixed Ijara rate Sukuk, the duration is around 1.5 years.
Thank you, Imran sir. The next question by Sayyid Murtaza Hassan is: can you please provide guidance on the decline in fee and commission?
So, Murtaza, if you look at the breakdown of our fee and commission income, you would see that there is a healthy increase in trade-related fees. There are two particular lines where you are seeing a decline. The first one is in debit card-related fees. As I've mentioned, the fee has declined primarily due to one-off cleansing of our dormant cards portfolio, which was incurring a cost for us but not earning any income. So we have closed those cards. But if you look at the growth trajectory, we are looking to add another 7 to 800,000 cards to our debit card portfolio over the next 9 months, which would obviously be contributing a healthy bottom line to our non-funded income. In terms of the other line, which is showing a decrease, that is the investment banking fee income, which again depends on the timing of the mandates. So in the first quarter compared to last year, we are seeing a sequential decline, but we are again hopeful that we'll be able to meet our investment banking related fee targets for the year. But it is not a straight line, income accrual which happens on the investment banking sort of mandates. It's generally based on when we are able to win those mandates and when we are able to deliver. So this is not something which is on a straight line basis, and I'm hopeful that based on our discussion with the business lines, we would be able to meet our investment banking fee targets as well. So overall, I would expect our non-funded income to grow at around 15 to 20% this year as well.
Thank you, Vinasa. The next question is by Mr. Mohammed Saklan. The question is, how many new branches are expected in 2025, and any plans to change the dividend policy in the near future?
So let me try to answer this. Apparently, you have seen our dividend strategy. We have paid a dividend of 7 rupee per share. And although this is something which boards recommend and shareholders decide, but I think the strategy of the bank will be very similar to what you have seen in the first quarter. As far as opening of new branches is concerned, so right now we are re-evaluating our strategy with reference to opening of branches, because there was so many changes during the last quarter of the previous year when we had to apply and plan for branch licensing. We had an MDR, we had an ADR, and we had a declining policy rate. All three variables, which were pretty uncertain then, were in play at that point in time. So right now we are re-evaluating, and we will then in probably next briefing will be able to let you know what is our branch expansion strategy going forward. Right now it's a moderate strategy. We will open some branches on those pockets we expect where there is a significant deposit, but post our thorough evaluation, we may end up having a slightly aggressive stance on opening the branches, subject to certain other variables in the market. We have to also evaluate the impact of US tariffs on Pakistan, which is another looming risk. So all these things will be taken into consideration before committing any additional fixed cost. And plus, we are also experiencing a very healthy growth from our existing branch network. So if you see, only in the first quarter, there's a growth of 177 billion in current account, 100 billion in saving account. So that's a pretty decent growth.
Thank you, Amisa. I think there are one or two questions following which have already been answered during the discussion. So there's one question that will come to is by Shah Farooq. Can you give us an outlook on overall administrative expenses? Imanasa, would you like to take that, sir?
Thank you, Shahab. As I've mentioned previously, in terms of the variable compensation expense, it is primarily a function of bottom line profitability. Obviously, our aim is to maximize the profits, or at least bring it in line with our prior performance. So that would obviously lead to the relevant level of variable compensation expense. In terms of other admin expenses, as I've mentioned previously, we expect those to increase in line with inflation. Current expectation is an inflation rate of around 7 to 10%, and I would expect our admin expenses to grow in tandem with that projection.
Thank you, Imanasa. There's a question by Mr. Hassan Raza. There was a significant NPL buildup of around rupees 5 billion. Was it subjective downgrade, and was it concentrated across certain sectors, or was it broad-based? And the outlook on asset quality.
So let's try to answer. Imran will talk exactly about the numbers, but on the outlook, the asset quality is very strong. We don't see any issues in the specific assets booked by Meezan Bank, although there are some stresses at this point in time on the textile sector. The exact impact is unknown to anyone, and that's coming because of the US tariff regime, not just on Pakistan, but also on China, because some of our exports end up in China, and from there, these goods which are exported here or raw material export, they end up in US markets. So that can be one risk which we are factoring in. And to factor that risk, we have subjectively went for certain provisioning. So original idea was to do some provisioning, and then we looked at specific accounts, because as you know, we cannot do general provisioning anymore post IFRS 9. So now we have to be more specific when we are doing any provisioning. So we just look at our portfolio and then try to identify those accounts which can then be subjectively downgraded. So as a result of that, you have seen an increase in NPL more than the increase in provisioning, because now when you go for a subjective provisioning, it is specific provisioning. And then you have to first downgrade under that account and then do a provisioning. Couple of years ago, we used to do a general provisioning to cover those looming risks. So there are certain looming risks which are coming primarily out of US tariffs. We could have covered those through general provision, but because of the regulatory regime, now we have to be very specific, identify accounts on subjective basis and do provision. Imran, you can add if you like to add anything on this one.
No, sir, I think you've Amir Saab covered everything. I would just like to add that although you might see a slight increase in our NPL ratio, that is, as Mr. Amir Ali mentioned, being driven by specific provisioning in the textile sector, but also our overall financing portfolio coming down. So otherwise, we have not seen any significant or material deterioration in the asset quality of our existing financing portfolio, and there we remain very confident. Thank you.
Thank you, sir. This question by Shan Sheikh of HBL. Partly it has been answered, I'm guessing. And the second part of his question is, what are your expectations for industry deposit growth and the policy rate? I think, Imran sir, generally you had answered that question to some extent. Mr. Ahmed sir,
So
please.
policy rate, I think Irfan Saab has answered. Now, you being from the capital markets are even better than us in predicting inflation outlooks and interest rates outlook, to be very frank. And even in our internal meetings, we look at 5, 6 different brokerage houses reports to understand what they are forecasting. So inflation numbers, we have seen it's 0.7% in the month of March. The inflation outlook is hardly 5 to 7% anywhere. So there is a lot of room for central bank to go for a rate cut. But when you go for a rate cut, then you have to also keep in mind your impact on your current account surpluses and deficit. Luckily, we have a current account surplus this month, and on an overall basis, we have $1.8 billion current account surplus. But there is still a looming risk of repayments. So this year we had to pay back $26 billion. $16 billion have been rolled over. I think out of remaining 10, 6 has been paid, $4 billion still need to be paid. So I think the central bank will be cautious about the overall policy rate stance. There is a possibility of slight cut, as Irfan Saab mentioned in his opening remarks, but we don't see a significant cut. And the industry deposits, I think they are bound to grow because there is now one thing which has changed. Last year, there was an ADR issue for last couple of years coming in and coming out. Now that issue is gone, so industry is very clear that whatever deposit they raise, even if they are not able to deploy in financing due to lower GDP growth rate, they will be able to deploy into investment instruments. So I think we will continue to see deposit growth in the industry as usual. There will be no significant growth, no slower growth. So there will be a decent growth in the industry average deposits.
Thank you, Amsa. We have a question by Mr. Nadeem Elahi. After last year's record-breaking ROE, what ROE does the management feel they will be able to achieve this year?
So let me take that question. Nadeem, we generally don't chase after the ROE numbers because the long-term robustness and health of our balance sheet and profitability is our top priority. As you are aware, I mean, meeting ROE targets is, chasing after a false premise, because you can also increase ROE by improving payouts and reducing your equity base, which is not something which we have tried to do in the past, neither is that something we'll do in the future. So our aim is to obviously close the gap as much as possible from the high profitability numbers from last year. I think the quarter has went very well, and we'll continue, inshallah, on that trajectory. But a target ROE is not something that we have in mind because of the reasons I've just mentioned, that it's easy to meet that target, not just through higher profitability, which is what we would like to achieve, but also through higher payouts and reducing the equity base, which we would not want to do. Thank you.
Thank you, Manasa. The next question is by Mr. Talha. Does the bank foresee higher interest rates in Pakistan going forward with the rising US Treasury yields?
So, Talha, I think our view is that the credit swap rates between the US Treasuries and the Pakistan yields are already at a all-time high. Although there is going to be some uptick in the US Treasury yields, given the differential between the forward-looking inflation rate in Pakistan versus the current policy rate, at least in the short term, our expectation is that the rates would not go up. However, that situation can change very quickly as the impact of the US tariffs become more prevalent, and as we know more, perhaps those expectations might be revised. But at this stage, the expectation is that the policy rate is going to stabilize at either current levels, or maybe there would be another slash of between 50 to 100 basis points, but we are not expecting any policy rate increase in the short term.
Thank you, Mr. Anand. I think the last question is by Hassan Raza. How much increase in deposit cost in basis points was on account of increase in profit sharing rate in the first quarter?
So, Hassan, the impact of the imposition of MDR on a total portfolio basis was around 4 billion at the profit before tax level.
Thank you, Manasa. So we have no more questions on chat, and there are no further raised hands. So I'm guessing we've answered all the queries of the participants. We'll now, I think, therefore, we are coming to the close of the session. We would like to thank everyone for joining us. And thank you, Irfan Saab, Amin Saab, and Imran Saab for being with us and answering all the queries. Thank you very much, everybody. Looking forward to seeing you next time, inshallah. Assalamu alaikum. Khuda Hafiz.
Yeah, man.
Thank you.